To understand the gravity of American student debt, look at the top-line numbers. 43 million borrowers holding roughly $1.7 trillion in federal loans. Every one of those dollars started out as an investment in a degree and a career. This demographic grid breaks down the current status of those borrowers. Right now, 12 million of them, that is exactly 1 in 4, are falling behind, sliding into delinquency or outright default. This wave of missed payments is the direct fallout of a system returning to life after years of pandemic-era payment pauses, combined with massive logistical chaos among the companies servicing these loans. And the situation fractured entirely when the courts struck down the Biden-era SAVE plan. That legal blockage stranded roughly 7 million borrowers in administrative limbo. With those standard safety nets abruptly removed, the friction in the system is gone. Hoping the problem will solve itself is no longer a mathematically viable strategy for anyone holding a balance. The immediate threat for millions of people is federal default. In the federal system, you officially cross that threshold the moment you go 270 days without making a payment. Once you cross that line, the government automatically activates a series of financial penalties. They will garnish up to 15% of your wages, seize your tax refunds, and offset your Social Security benefits to recover the debt. Based on current trajectories, 10 to 13 million borrowers are projected to hit that specific devastating status by the end of 2026. This means ignoring a federal student loan carries consequences far more severe than a temporary hit to your credit score. It results in immediate, unavoidable extractions from your actual take-home pay. The rules governing how we navigate out of this mess are completely rewriting themselves. The upcoming 2026 legislative overhaul, often referred to as the Big Beautiful Bill, permanently alters the repayment landscape for both new and existing borrowers. Historically, borrowers had to navigate a confusing alphabet soup of repayment options. Starting soon, older programs like PayYE, ICR, and the embattled SAVE plan are being entirely eliminated. This side-by-side comparison shows the new, simplified reality taking effect in July 2026. Going forward, the vast majority of borrowers will be forced to choose between two main paths: income-based repayment, or IBR, and the newly created Repayment Assistance Plan, known as RAP. Looking closer at these timelines, IBR offers a shorter horizon, forgiving your remaining balance after 20 to 25 years. RAP stretches that requirement out to 30 years, but it comes with distinct cash flow benefits, a hard minimum payment of just $10 a month, and a total waiver on any unpaid interest, so your balance cannot grow. By stripping away the clutter, the overhaul simplifies your choices, but it also means every borrower has to run the math and actively opt in to the specific path that fits their earning trajectory. But there is a massive catch tied to both of these plans. Starting January 1st, 2026, any balance forgiven through an income-driven repayment plan becomes federally taxable. If you have $50,000 wiped out at the end of your term, the IRS will treat that as $50,000 of earned income for that year. The only exception to this new tax penalty is public service loan forgiveness. If you qualify for PSLF by working for a government or nonprofit employer, your balance is wiped completely clean and tax-free after 120 qualifying payments. Knowing these changes are coming, some borrowers might be tempted to refinance their debt into a private loan to secure a lower interest rate. You need to be incredibly careful. Refinancing to private debt strips away every single income-driven protection and eliminates all paths to forgiveness. Even with a potential tax burden waiting at the end of a 20 or 30-year term, the federal safety nets are vastly superior to a private loan that offers absolutely no escape hatch. For the millions of Americans already in default, long-term planning has to wait. You need an immediate exit strategy, and it has to go through the Department of Education. Right now, the government is running a special one-time cure called the Fresh Start program. Enrolling in this instantly pulls your loans out of default and restores them to good standing. This chart compares your timeline options, and it shows exactly why you cannot wait. Fresh Start is scheduled to expire in mid-2026. Once that deadline passes, the only way to clear a default will be standard loan rehabilitation, a grueling process that requires 9 consecutive months of manual payments. Expanding on these timelines reveals a massive secondary benefit. Using Fresh Start preserves any past credit you've built toward public service loan forgiveness. If you are forced to use the 9-month rehabilitation path instead, that clock completely resets. Fresh Start is a temporary lifeboat. If your loans are in default, you need to contact your servicer and board it before it is pulled away entirely. If you are behind on your payments but haven't hit default yet, your immediate goal is to halt the slide. Contact your servicer today and request to enroll in an income-based repayment plan, which can protect your wages from garnishment even if your required payment drops to $0. If you are one of the 7 million borrowers stranded by the end of the SAVE plan, you need to pivot. Go to the loan simulator on studentaid.gov right now to calculate whether IBR or the new RAP will be cheaper for your specific income and balance over the next few decades. For public service workers, the strategy aid is documentation. The 2026 rules for eligible employers are tightening, so you must relentlessly certify your employment every single year, rather than waiting a decade to see if you qualify. The era of passive borrowing, confusing options, and endless payment pauses is permanently over. Surviving this overhaul requires you to look at your balance, understand the new rules, and take informed action before the final deadlines lock you in.